Good evening, class, and welcome to our performance management class for today. Today, we are taking the topic called transfer pricing. Transfer pricing is a very interesting many times in ICANN past questions or ICANN exams. And so this topic is an interesting one because we shall be able to do some workings here to understand this topic. Now, what are we going to learn today? We are going to see transfer pricing, purpose and objectives. We are going to see problems with transfer pricing. Then we'll look at transfer pricing in practice. Then the implication of taxation and repatriation of funds. While you are not doing taxation, transfer pricing is actually a taxation problem. So, but you are doing the calculation part of it, which is the performance management part. But when it is time for the impact of taxation, you will see it. All right, now let's go now to the introduction. When a company has divisions, branches, units, subunits, now let's take it that it's divisions. Some divisions might be selling their goods and service to another division in the same company. Now let's look at a group of companies, say Dangote Group. That's a fine example. Now, Dangote Group may be selling Dangote Sugar to another group, maybe Dangote Refinery or maybe Dangote Salt. Dangote Refinery may be selling something selected to Dangote Cement. So it means that one division is selling, which we will call the selling division, and one other division is buying. Now, instead of using the word buying and selling, we use the technical word transfer. Now, why do we use transfer? Transfer is simply used because the transaction is within the group. It is not going outside. And so, look at this example. A mother is selling in her shop and the husband comes to buy from that shop. Yes, the husband pays the exact money that the item is being sold for. Now, did the husband really purchase? Because the money is going from the husband to the wife, it's still remaining in the family. Now, perhaps the children comes to buy. It is still in the family. They are in one group. Money has not come from external source. So if you are checking out the profit made or the income made by the household, these monies from the family is not going to be counted because it is just transferring from one pocket in the family to another pocket. So that's why it is called transfer, because no external party has come to either buy or sell. When the sell is between the internal structure, then it is called transfer pricing. Now, for the purpose of accounting, these internal transfers of goods or services are given a value. Of course, just like sales is given a value, the internal transfers are given a value so that it can be recorded. Now, these transfers could be recorded at cost if the people involved or the selling division is a cost center. But if the selling division is a profit center, it will be recorded both at profit and at cost plus, or cost plus a profit. So you see here that it could be recorded at cost, it could be recorded as profit. Now, why could it be recorded at cost? It is recorded at cost in the sense that these people are just holding the goods at cost. They're not making profit. It's just like saying that one group of the company is a store, the other group is manufacturing, and so they come to the store and they collect it and they go to manufacture. So it's issuing it out at a cost. But if it is they want to make a profit could be in a process, let's say a parent and a subsidiary, and now the parent is selling to the subsidiary, or the subsidiary is selling to the parent. They could be recording it at a profit. And so transfer price is the price at which goods or services are transferred. I don't want to use the word sold, are transferred by one division called the selling division or the transferring division to another division called the receiving division or the buying division in the same company or group. Internal sales are called transfers, like I said, and the buying price is also called the transfer price. Now, a division has to be made about the price that should be transferred. So, when this transfer is occurring, there should be a decision how much should be the price to transfer. Now, the transfer price could be on the cost of the item, that is to the selling division. So the selling division could transfer at a cost. So it means that if I'm transferring, how much is a bag of rice now? If I buy the bag of rice, say 50,000, and I'm transferring it at 50,000, it is at a cost. Now, it could also be transferred at a cost higher than the cost price. So it could be at a profit margin. Say I want to make 10% profit, that means I'm going to transfer it at 55,000. If I want to make 20% profit, I will transfer at 60,000. So there are possible methods that transfer pricing could be. It could be at marginal cost. We'll get to find out what marginal cost is in transfer pricing. It could be at full cost. It could also be cost plus. It could also be in market price. Now let's take this in turns. Now, if transfer price is at marginal cost, what is marginal cost? Marginal cost is the variable cost or the cost of one extra unit. So marginal cost is like variable cost. So if the transfer price is at a cost, variable cost or marginal cost to the selling division, that means it is transferring it at marginal cost. So marginal cost and full cost. Full cost now involves both variable cost and fixed cost. Now let's look at this example. Division A makes a component. Now this component could be anything. Let's call this component let's use minerals, soft drinks, and now this component could be the crate or the bottle. Okay, so let's use bottle. So it makes component X, let's call it a bottle, which is transferred to the division B. So that means the division B is the actual division that is doing the drinks, that will now have to put it in bottles, put it in the crate, and cork it. So let's say this component called crate is transferred from A. A is making it or buying it, then transferring it to B. Okay. B uses this component X to make the end product. So it means that that bottle or that crate is what, okay, let's say it's bottle. Let's not call it crate. Let's call it bottle because it could be plastic bottle. Let's call it bottle. And we use that bottle to make the end product. The end product is the plastic bottle with the drink. Now, details of the annual budget for both the selling division and the buying division. So you see here, who is making the transfer? The one making the transfer is the selling division. Then the one receiving is the buying division. So for the sake of clarity, we use buy and sell. Now we see that division A, which is the selling division, produces 1,000 bottles, right? And division B is selling 1,000 drinks, right? Now, division A does not sell the final product, right? It is division B that is selling the final product. So for them to sell it at 350,000, it means they are selling, one of them is 350 naira. 350 naira times 1,000 is 350,000. That's the selling price. So cost of production. Now in making this crate of, is making these bottles, they spent 70,000 naira in making these bottles. And the fixed cost, now this fixed cost is allocated fixed cost. So it could be fixed cost allocated and apportioned. It doesn't matter what is the fixed cost, but this is a fixed cost that is attributable to the selling division, which is 80,000. Now, this is the total cost. 70 plus 80 is 150, right? Now, in the buying division, this is how much is selling the product. Now, the variable cost for making this product is 30,000, whereas the fixed cost is 90. When you add the fixed and variable cost, it has come to the cost of 120. Now, if you look at it, the budgeted annual profit for each division, if the units of components are transferred from A to B at marginal cost. Now, we are looking for, what are we looking for here? We are looking for annual budget profit. We are looking for budgeted profit because this is not a real life transaction. It is for planning purpose. This is budgeted. So what is it going to be? If they are going to transfer at marginal cost, that is one of them, and we are transferring at marginal cost now. Now, if we are transferring at marginal cost, remember the marginal cost here is what? 70,000. So now this is what we are going to do here. We are producing the bottles at 1,000 naira. We are not making the external sales. But if you look at it now, you are selling it at marginal cost. And your marginal cost then was 70 naira, which gives you 70,000 naira. Of course, that 70,000 naira we got here, if we are to divide it by 1,000, it means 70 naira per unit. So we are selling each one 70 naira. So it means that if you are selling it to the buying division, this 70,000 naira will be your revenue. So to the buying division, when it transfers to the selling division, the money it gets from the buying division is revenue. So this is the revenue. So your total sales is 70. Now you have transferred it at variable cost. So you come here when you are dealing with cost. This is the money you receive from B. This is the amount you make the product. This 70,000 is that 70,000 we saw. The 80,000 is your fixed cost, and your total cost happens to be 150. Now, when you want to make your profit will now be your sales minus your cost. So it means that you are making a loss of what? Of 80,000. Now, can you see this loss? Your loss is equal to your fixed cost. The loss is equal to your fixed cost. Now look at the buying division. The buying division bought, this is what it sold the drink, 1,000 drink. It's selling them at 350 naira times 1,000, which is 350,000. All right, so let me recap what I said before for better clarity. Now, we are asked to produce a budgeted profit, and this 1,000 units is like the crates that, or the plastic bottle that were being sold. Now, this plastic bottle is 1,000, and you made them for one of them is 70 naira. So because you are selling it at variable cost, your variable cost is this 70,000, we are giving it to the B division at 70,000. That means each one is 70 naira each. And so as you are selling it to B, you are making a revenue. So it means that for A, who is the selling division, the transfer price is a revenue, 70,000. 170 naira times 1,000, 70,000. So the only thing that it is getting from this bottle is 70,000 naira, which it sold to B. Now, coming to cost of production, the, the production variable cost was 70,000. So it means that this 70,000 is the same 70,000 naira that was used in selling. So you produce it at 70,000 and you sold it at 70,000 to B, right? Then your fixed cost happened to be 80,000. When you add your variable cost and your fixed cost, you get total cost, because total cost is variable cost plus fixed cost. Now, if you are checking your profit, this is your sales 70,000, this is your profit cost 150. That means you have a deficit or a loss of 80,000 naira. And I told you to look at it well. Whenever the selling division is selling at variable cost, it will never make a profit. It will make a loss. The loss will be equal to the fixed cost. Now, going to the buying division. The buying division is making 1,000 units of drinks and is selling it each 350 naira. So that means the sales from the drink is 350,000 naira. And that's the sales revenue. Now, that's the total sales. Now, how much is its cost? The first thing we'll check is it bought it bought bottles from division A. So as it is buying this bottle from division A, it is a cost to B, it's a revenue to A. Remember, A sold it at variable cost. That's why it is 70,000. And it means that B bought it at 70. It is a cost to B. It is a sales to A. Now, this is internal transfer. So you see here, internal transfer in the form of revenue will be in A. in the form of cost will be in B. And so these two cancel out. It's just like saying the mother is selling the bottles, the father is selling the drinks. The father went to buy from the mother, and in the group, this 70,000 is not an external revenue, so they cancel out each other. What the father spends to the mother receives, so they cancel out. So you can see now the 30,000 is other variable costs that we can see here from the question. This 30,000 and this 90,000 are the same thing here. And so when you add my network like this, when you add everything together, just hold on a moment. Okay, so let me share my file again. All right, so when you make a transfer like this, okay, so we see that the 70,000 naira is a cost to B plus the other additional costs of 30 and 90. Before it was 120. When we add the transfer cost, it becomes 190. Now 350,000, which is the sales, minus 190, which is the cost, gives us a profit of 160. So for the buying division, it is making a profit of 160. For the selling division, it is making a loss of 80. Now look at the company as a whole. How does it affect the family? How does it affect the group? Now, the group will be selling the final product. The group as a whole will be selling the final product. And so, whatever sales revenue that B gets goes to the group. Now, look at this internal revenue that A gets. It doesn't add any value to the group. It's just like saying, okay, let's bring out all the revenues we make in the family. The mother now brought everything she sold, including what she bought from the father. And it doesn't add up to the group materially because it is just a transfer from the father to the mother. So this transfer does not add any value to the group. All right. So it means that as a whole, the company is making a total sales of 350. Now, coming to cost, this 70,000 naira that the buying division spent to the selling division doesn't affect the group. So what it means that your internal transfers does not affect the group. It doesn't affect the group's revenue, neither does it affect the group's costs. It doesn't affect the group's profit. But now let's look at it now. Now, the other variable costs. Somebody is still asking a question. Why is the unit produced not 2,000 naira, 2,000 sir? All right. Now, you have 1,000 empty bottles from A, and you are going to use all the empty bottles to produce drinks. If B produces uh, um, the drinks, how many drinks will be sold to the external party? It's 1,000 because they are not selling the bottle alone to the external parties. The bottle is a component used in making the drinks. So the final product is what B is selling. That is the final product of the company. The company sold 1,000 drinks. A sold just 1,000 bottles to B. B bought 1,000 bottles from A to make 1,000 units of drink to sell to the external market. So the total sale in the company is 1,000. External sales is that same 350. The 70,000 naira transfer doesn't affect the group. Even the costs, the 70,000 does not affect. Now look at the other variable costs. The cost of making the bottles, 70,000 naira, is also affecting the company. The cost of making the drink, 30,000, also affects the company. So when you add them together, you have 100. The fixed cost of 80 and 90 affects the company, so it becomes 170. When you add all the costs to the company, it's 270, and you remove it from the sales, it becomes 80,000 naira profit. So if you see now, the buying division is even making more profit than the company. So whenever sales is at variable cost, the buying division gains. The selling division loses at the fixed cost. And the company as a whole is making lesser money than division A. So you can see here, for the company as a whole, the internal price transfers are not affected, are not included in the sales and the cost. The transfer affects the financial results of just the divisions. By transferring goods at variable cost, the transferring division earns revenue equal to its variable cost of production. So here, your revenue will be your variable cost, right? That's fine. It also bears the full cost of its fixed cost, and it records a loss equal to its fixed cost, like I told you. So this fixed cost will become your loss. On the other hand, the buying division records a profit because the fixed costs of division A are not included in the transfer price. The profit of division B exceeds the profit of the company as a whole. That is what happens when you sell at variable cost. You sell at variable cost, you are the selling division, you will make a loss of the fixed cost. When you buy at variable cost from division A, it means you make high profit because you are buying it very cheap. Now the company as a whole will make a profit lower than that of the buying division. Now let's see what will happen when the transfer at marginal cost actual sales higher than budget. Now let's see this situation here. The same situation occurs if actual output and sales differ from budget. If actual output differs from the budget, it means that if production and sales are 1,100 units, the profit of division B will still increase and A will still make a loss equal to its fixed cost. So it doesn't matter how whether it is the actual or the budgeted, the same result will occur. Now what will happen is still the same thing here. So let's go straight to transfer at full cost. Now, if it is transferred at full cost, how will it play out? Now, in this example, the full cost produced in division A is 150. How do we know? Okay, this is 150,000, right? 150,000 means variable cost plus fixed cost. So it means that the sum of these two, that is what was used in transferring. So that means it is at 150 naira per unit. All right. So let's see how it plays out. Once again, because you transferred at full cost, you are using your full cost 150 naira per unit multiplied by 1,000. That is your revenue. So this is your revenue. This is your revenue, and it's equal to your total cost. So your revenue is equal to your total cost. Of course, we know that the variable cost and the fixed cost is here, and your profit will be what? 0. So whenever you transfer at full cost, you will break even. You will break even. You will never make a profit nor make a loss if it is the selling division. So it is better for the selling division to transfer at the full cost so that it will neither make a profit nor make a loss. Now, but let's see what happens to the buying division. The buying division buys it and makes the bottle, the drinks, and sells at 350, which becomes their revenue. But now this is the transfer. Because it is transferring at full cost, it means this is the cost to the company or to the division B. This is revenue to division A. Now the 30 and the 90 remains the same. And now this is 270. 270 taken away from 350 becomes 80. Now the same result plays out in the company as a whole because the full drink is sold out. These two cancel themselves so it doesn't affect. When you add these two together, the variable cost, it gives you 100. You add the fixed cost together, it gives you 170. When you add them together, you are having 270. 270. Isn't that a coincidence? Now, when you remove it from cost of from sales, you have 80. So what it means here is that whenever you are selling at fixed cost, the division B and the company will have the same, whereas division A will have 0. Whenever it is at full cost, the selling division will not make a profit. The buying division will make a profit. And as we see here, the profit is equal to the fixed cost. The profit here is equal to the fixed cost here because, okay, that's it. But sometimes it may not be the same way. But it's just that here, the buying division and the company will be making the same amount of profit. Unlike when it was sold at variable cost, the buying division is making a higher profit than the company. But here, they are making the same thing. So since the transfer price includes the fixed cost of the selling division, division A is able to cover all its costs. That is why it is called a break even, and it neither reports a profit or a loss. The buying division has to pay for the fixed cost of division A in the transfer price, and it still records a profit. But the profit is now equal to the profit earned by the company as a whole. So you can see now, we have seen two things. When there is variable cost, the selling division loses. How much does it lose? Its loss will be equivalent to the fixed cost. The buying division gains very well. How much does it gain? It gains far more than even the company. Now, when it is transferred at a full cost, the buying division does not still make, the selling division does not still make a profit, but now it doesn't make a loss. Now the profit of the buying division has reduced because a fixed cost has been added, and now it is going to be making the same profit with the company. So it means like the selling division is the one that is making the profit for the company. So a similar result will occur if the actual result is different from the budgeted. So let's leave that because we know it is the same result. Another way to do your transfer price is at cost plus. Now let's look at it. Let's analyze it now. For the purpose of performance management and performance evaluation, it is appropriate to use profit center. Of course, in the previous example, the selling division was not a profit center. That's why it didn't make a profit. It was a cost center. In the first example, it transferred at variable cost. In the second example, it transferred at what? Fixed and variable. That is total cost. No profit. So it is just a cost center. It is the buying division that is a profit center because it's selling its goods as a profit. Now, in transferring at cost plus, it means now that the selling division is now a profit center and it has to earn some profit in its transfer to division B. And now the buying division will now be able to pay a fair price for the goods and services, not just the cost. Now, one way of arranging for each division to make a profit on transfer is to set a transfer price at an amount above cost to provide the selling division with a profit margin. But that should not be too high as to make the buying division to make a loss, because you could say, okay, the last time I sold you in variable cost, I make a loss and you are making a profit. Now, when I'm going to make my own cost plus, I'm going to put too much a high price so that when I sell it, and you are going to sell and you are going to make a loss. No, the buying division should buy it at a cost plus and still make a profit. The selling division will sell at that cost plus and also make a profit. Now let's see an example of that. Looking at this same thing here, it has now changed to division C and D. For the sake of this example, it has changed to division C and D. But if we are to still use the division A and B in our mind while calling it C and D, now let's say this component is still the same component we have been using. Now it has changed from X to Y, and Y is the component and Z is the end product that division D makes. So now this is the selling division. Let me indicate this as S, selling division, while this is the buying division. All right, so you see here, this is selling the bottles here, 1,000 units. Okay, this is the same result. This is the same question. But now, the budgeted profit is what we are looking for, and we are told that division C sell at cost plus 20%. So what it means here is this is a markup. I've told you before, there is a difference between markup and margin. So markup of 20% of total cost. What it means is 0.2. Okay, if you want to do a markup, let me do it in a professional way. Instead of finding 0.2 of 150 and then adding it back, I will just say 1.2. So this is 100% plus the 20% markup. 1.2 times 150,000. So what will it be? What will it be? Let's see. 1.2. If I multiply by 150 alone, which is the price, it means they are selling at 180 multiplied by 1,000. So you see, this is 180,000. So it means that your total cost is going to be at 180,000. It means here 150 naira times 1.2 giving us 180. So 180 per unit is what it is being transferred. That is the transfer price per unit. Now let's see how it plays out. Just like I said, the full price is a cost plus of 20%, which is 180. You've seen how we got the 180. Now, it means that it is selling at 180 per unit multiplied by 1,000, making it 180,000. That is a revenue for the buying department. Let me put B there, or buy. This is selling. So this is selling department, and this is buying department. So the selling department of that component Y is making 180,000 from it. All right. Meanwhile, the buying division is buying it and using it to make the final product and selling it at 350 per unit, which is 350,000 as stated before. So the transfer, so this is the same transfer. So you put the transfer as the revenue for sale, you come immediately and put it as the first cost for the buying department so that this cancelling effect must occur. Right? So this is at a cost plus. Now you see here 70,000 and 80,000 as before, 90 and 30 and 90 as before, 100 and 170 as before. Now you find out that the selling division has now made a profit. A profit has been made. Buying division has made a profit. But you see, the company as a whole, the profit will be the profit from the selling division plus the buying division gives you the profit as a whole. That is how it is. The selling division's profit and the buying division's profit will give you the company's division profit as a whole. When the selling division was making a loss of 80,000 and buying division was making a profit of 160, did you see that when you loss of 80 plus profit of 160 to give you a net profit for the company of 180, right? Now, in this case, can you see now that the company's profit is still unchanged? 80. If you look at that other example, the company's net profit here, okay, no, it's not this. The company's net profit is still 80. When you look at the first one here, it is also 80. It's also 80 here. So you see, the company's profit does not change as long as this is the scenario. So what changes now is the profit for each division because we are doing a kind of divisional performance. The company's profit as a whole does not change, but you see how it is being shared. In the first example, the selling division had a loss, and so the whole thing went to the buying division. The buying division is even absorbing the loss of the selling division. Company is 80. When the company selling division made a zero profit, the buying division made 80. And so the company is 80 because 0 plus 80 will be 80. Now the selling division is making a small profit. Now the buying division's profit has come down because selling division has gone up. And so it is 80. It is possible that there could be a price that will make the buying division and the selling division sell at the same price. It's possible that both of them could have profit of 40,000. Which price is that? It's possible you may be asked in the exam, but that is not what is being covered here. So you see, a cost plus transfer price succeeds in giving profit to the selling division and shares the profit, brings down the profit of the buying division so that it will not make too much profit and the selling division will also make not too small a profit. Now, let's look at another transfer price. Transfer price at the market price. So now we have seen three pricing method. One is at variable cost, so take note of that. The second one could be at full cost. The third one could be at cost plus. And the fourth one is market price. So it is possible that you can be asked a question. Question number one, they give you the whole question and they say transfer if the transfer price is at A, variable cost, B, full cost, C, cost plus 20%, D, market price of say 160. Now let's see if the market price, now an entity is G and K. Now they have changed the name, but we know what's happening here. This is the selling division and this is the buying division. Okay, it is still the same thing here. Now D budgets to sell one half of its output to K. So what is happening here is it is selling half to K and the other half to external. So now because it is selling to external, that means there is a revenue coming from outside. Okay, it's selling to outside. Now, the market price for the component, we are calling it bottle, is 160. We are selling it to the market at 160. And it has been agreed. You have to look at the agreement. It has been agreed that the transfer between the divisions should be at market price. So it means that it is 160 that will be used to sell to the external market and be used to sell uh, uh, to the buying division. So it doesn't matter how much was being sold to the external market. What matters is what is the agreement between the selling division and the buying division. What price is agreed on? It is market price. Now let's see. Now, because they want to sell to market, they have made extra 2,000. They have made 2,000, right? So what happens here? 1,000 is given to this division, 1,000 is sold to the market. So look at the selling price. It means they are selling each of them at what? 160. Now, why are we having 160 here? Because we are going to multiply by 1,000. This is the 1,000 you sold to external markets. That is what is having here 160. Sales of final product. The final product is the bottle. You sold 1,000 to final product. Meanwhile, the other 1,000 is transfer and not sales of final product, because when you transfer it, it is still a component used by division K in the company to make the final product. Now your variable cost now happens to be 140. Why is it 140? Because we are doing two products. You know, this is 70 naira times 2,000 bottles you are doing, it gives you 140. Your fixed cost remains the same. It doesn't depend on the volume of activity. So your fixed cost remains the same and it remains the same here. Nothing changes in division K because it is still business as usual. We are still getting our 1,000 bottles and business as usual is happening. But you see in division G, which is the selling division, it is not business as usual now. They now are making two times the product they are making before because they are giving external one and are transferring internal. So what happens now? Total cost for division B, division G has now grown to 220. Division K, which is the buying division, is still 120. Now we want to look at their profits. Now let's see how it plays out. Now you can see here that division A, or this is the buying division or selling division. This is the buying division. You always put the selling division first. Now they are producing 2,000. This person is producing final product 1,000. The company as a whole is selling, the main thing that the company is selling is this 1,000 drinks. All right, so what happens? Sales of external products. This is the drink Q. They are selling 350 naira each and it becomes 350,000. Of course, it will reflect on the company. Now they are selling component bottle. Now this is the bottle that was sold to the external market. That's one half. They sold it at market price of 160 and they're selling 1,000 and it becomes 160. And you see now it is reflecting on the company because this is sales to external market. Then this is the transfer it's made to the internal division K. So this is a transfer at market price. and this is the same transfer that is canceling out. So when you add these two, it becomes 320. This became is 350 here, and when you add this plus this together, it should be giving you what? It should be giving you, you're not supposed to add these two together to give you this, because this 160 does not affect. So when you add this here, you are getting 510. The reason why you're not getting 670 is because this is not reflecting on the company. All right, so it's 510. So the same thing now. Variable cost, we said before, it was 140. You spent 270 naira producing 2,000 bottles. So you spent 140 as variable cost, right? Your fixed cost did not change. It's 80,000 becomes 220. Now your variable cost and your fixed cost here remains the same. When you add them together, it becomes 170. But now you have seen here that the fixed cost has increased as a result of um the variable cost is the one that increased as a result of this increased variable cost in the selling division. So now what happens to their profit? Now the selling division has made a higher profit than the buying division. Why? Because it was able to sell to the external market and earn some profit. That's number one. Number two, it is also selling at market price. Now remember, it is selling, the market price in this instance is lower than that cost plus 20%. So it means that the market is buying that thing and making a less than 20% profit. That was the case. That was the case. Because if we say let 20% cost plus when it was okay, so if it is like this 160, 160 is less than 180, so it is making less than 20% in the market. But that's not the problem of this question here. But we have seen that selling division has made more than the buying division, but the total cost is 170. Now why is this different from this other one? You can see here that this is 170 different from 80. Now, the reason why it is 170, let's find the difference. 170,000 minus the 80,000 it has been making before is 90,000. 90,000. So that's it. So you see here that as a result of selling, this to the external market, this 160. So this 90,000, how did it come about? Let's do something here. Let's do something here. We have 160, which is the external sales, minus 70,000, which is the variable cost that was involved in this external sales. That is the 90,000. So it is the margin, I will call it the contribution from external sales. It's what has increased the company as a whole. So if the selling division is selling to the external market and earning a contribution on that, it will impact positively on the company as a whole. So because the transfers are at market price, it can be argued that the profit of each division is a reasonable measure of their performance. Now, we've seen different things here, selling at market price. Now, I want to tell you something. Assuming it is not selling to external markets and it's only making 1,000 units, but selling at market price, the company will still be making 80,000. This is because no external contribution is made by G from the market outside the market. So the company will still make 80,000 in that case. So the difference now was 90,000. We noted here that 90,000 is the contribution made from this minus 70,000 from here, because 70,000 is used for the one they sold here, and the remaining 70,000 is the one that was transferred. So it is that gave us that 90,000. That was the difference that made this 170. Now, what is the objective of transfer pricing? The objective of transfer pricing is that prices are determined by the management. And when authority is delegated to divisional managers, the managers of the selling division and the buying division, um, although they are autonomous, they are they are mandated to choose what is best for them, but they should be able to negotiate and agree on a price for the transfer, so that one will not make a profit and the other make a loss like that. The objective of transfer pricing should be to make it possible for each division to operate successfully, that is making a profit within the company. Even if they don't make a profit, they should not even make a loss, right? So even if I'm not making a profit, we should not make a loss in the company. That's one. And give freedom or autonomy to make decisions to the managers of the profit centers or investment centers. So each of them are profit centers. They're able to make profit decisions. So that is the autonomy. And enable the company to measure the performance of each division in a fair way. So you see here now, even though in all these instances, the profit of the company didn't change. But we now say that, okay, it didn't change. Let's measure the performance of each of these managers. They now use profit to measure, and now you are transferring at variable cost. Oh, you are making a loss. It will be seen that the selling division is not performing because it's making a loss. And then look at the buying division, it's making more profit than what the company is making. Oh, you are doing fantastic, fantastic. When they now transfer at full cost, it now brought it down. You now look at the selling division, you are still not making a profit, but we are happy you are not making a loss. And in fact, that loss it made the loss to the buying division, so it is pardonable. And now it is not even making a profit, and now the profit of the buying division has dropped such that it is the same thing with the company. Still giving kudos. Now you transfer at market price, or yes, at cost plus price, and this man says, oh, let me transfer at 180. It's going to be a negotiation. Should I transfer at 180? Is that a fair price? If the buying division agrees, they will sell it. So they are to make negotiation. Now, when they sell at 180, the buying division makes some profit, but it's very low. The selling division makes some profit, but it's still not as big as the buying division. They are still measuring their profits. The buying division may be scheming, all right, I will increase my profit so that I will increase my selling price so that uh, I will be making as much profit as the buying division. It might be selling it at 200, but now is 200 too much a price? The buying division might say, oh, if you are selling it to me at 200 naira, and I can go to the market and get it for 160, why should I be buying from you? And if it is so, the buying division should go to the market. But now the selling division will say, okay, sorry now, they know they play with you. I bring the 160. Let me sell it for you. Okay, so they have agreed that they will sell it at the market price. So that's just it. Now, autonomy is a freedom of action and freedom to make decisions. And managers should be free to make their own decisions. So autonomy should improve motivation for the managers. So that autonomy would be, if you're not selling it to me the way I'm going to buy it in the market, which is what we call arm's length principle. So arm's length, normally when we are talking about divisional performance, now when we are talking about transfer pricing, what is arm's length comes into play. It means I should be able to buy from my group the same way I am buying from the market. I shouldn't be buying something smaller. I shouldn't be buying it at a smaller price from my group. Then I go to the market to buy at market price. So it means that nobody should be coming to tell you that it's because of you, oh, it's because you are my person, oh, or it's because it's we. No, you are buying it the same way you are going to sell to external market. That is what they call arm's length. All right. So division managers can have that decision to either sell to internal market, and they will say, okay, we are not selling to you. Go and source it elsewhere. We want to sell to external market because you people are asking for a lower price and I'm not making profit. Instead of me to make a loss, let me sell it to the market. Now the buying division could say, okay, you are selling to me very high, right? Yeah, go and sell it now. Is it because it's me? Go and sell it to the market. If they will buy it from me, I'm going to the market to go and buy. So they should be able to make their own decision where to buy and who to sell to. Now, one thing that they should also do is to act in the best interest of the company. This is what we call group goal congress. Group goal congress. So group goal congress. So it means that the group's interest should be put ahead of personal interest. So you can see sometimes a manager will just take a decision and say, I am making it in the interest of the company. So it could be that the manager is sacking somebody close to him, but he will say, I'm not doing it for my own self. I'm doing it for the interest of the company. So his own interest doesn't count for that of the company. So it means that if the buying division is taking a decision, it should be thinking about the profit of the group as a whole rather than its own. So it means that if it is going outside to go and buy, instead of buying it from the selling division, is it going to improve the company's group profit or is it going to reduce it? That should be what should be uppermost in his mind, not the extra profit it is going to make. Then the selling division will be, if I am selling it to the external market, will it improve the group's profit, or is it better I sell it to the internal consumer, which is its buying division? Which one will give the improves the group performance? Now that is what you'll be seeing most times in transfer pricing. Unfortunately, divisional managers put the interest of their own division before that of the company because they are rewarded on profit basis, based on return on investment by each division, forgetting that whichever way you do it, the company's profit or loss is not affected. But because now external market is involved here, You can see in that last example, when external market was involved, there is an extra contribution that added to the profit. So instead of looking at their own interest, they should look at the interest of the company as a whole. They will sit down and talk about it. If we do it this way, we do it that way, what will it benefit to the company? And if they do that, are we still making profit? So in certain circumstances, the personal objective of divisional managers may conflict with the interest of the company, and a division may take action that minimizes its own profit but reduces the profit of another division. And as a result, the whole of the company's profit will be reduced. So that is going to be selfish of the divisional managers. Now let's look at problems with transfer pricing. Now we have external intermediate markets, market-based and cost-based transfer prices. Then we have opportunity cost and identifying the ideal transfer price. So we are coming to the very meat of this topic. All right, let's look at this external immediate market. Now, a system of transfer pricing should allow the divisional managers the freedom to make their own decisions without having to be told by head office what they must do. Now, at the same time, the system should not encourage managers to take decisions that will harm the company. So on the one hand, they are given autonomy, do as you please, but there's a caveat: don't do anything to harm the company. Now, the main problem arises when there is an external market for the goods and services that one division transfers to the other. Now, let's say, for example, there is an external market where that the selling division can sell its market to the external, and it can also sell it to the internal. When that external market exists, the there are the market might be called an external intermediate market because the external market is an intermediary. Now, the selling division can sell its goods to the market instead of transferring them internally. Now, will that action harm the company? That's the first thing. Similarly, the buying division can say, okay, instead of me buying these things from the selling division, I should go and buy it from the outside market. Will that also harm the company? Divisional managers will put the interests of their division most times ahead of the company. When there is an external intermediate market, divisional managers will decide between internal transfer using the external market price or whichever price that they deem fit. Now, market-based and cost-based transfer price. Transfer price is based on opportunity cost. So most times you'll be seeing opportunity cost in your question. Now, take note of this opportunity cost because this is very important. As a general rule, when there is an external intermediate market, okay, no, when it does not exist, when an external market does not exist, the transfer price should be based on cost. The transfer price should be based on cost. So now we'll be asking, which of the costs? It could be variable cost, it could be full cost, it may be full cost plus. Now, when an external intermediate market exists, the transfer price should be made on the external market price. So two things. If the market price does not exist, the selling division can say, okay, no, the buying division could say, all right, external market price does not exist. So if the buying division does not buy from me, I don't have anybody to sell to. So if they want to buy it at cost, I will give it to them. They are the ones who hold the yam and the knife. So they say it's variable cost, no problem. Full cost, no problem. They agree for me to make a cost plus, no problem. But when there is a market for it, wow, they have to do at market price because that is the arm's length price. So if you don't buy from me, you go to the market and buy the same thing. So, but the thing is, why should I go and buy the same price from the market when you are just my neighbor here and you can sell it to me and all I just need to do is just to take it than to spend the transport, spend delivery cost to bring it from the market when all I can just do is take it from the store in your store that is close to me. So they will buy, sell it at a standard market price. Now, there is a problem. The problem comes when there is a limit to production capacity in the selling division. So the selling division has a limit in the selling division, and there is a limit to sales demand in the external market. So in these circumstances, we need to consider the opportunity cost for the selling department instead of transferring the goods like that to the internal market. So what happened here is I have maybe 2,000 units of goods to make, right? And the buying division is asking me, please give us 1,000. And the external market is asking you for 1,005. So you can only produce 2,000. And your total demand is 1,000 plus 1,005. It means you have 2,005 to give out. Now the question is, that 500 that is the excess or the shortage, whom are you going to short it from? Will you short it from the external market, and why? Will you short it from the internal market, and why? Opportunity cost comes here. Now, opportunity cost of transfer. The transfer division or the selling division and the buying division have opportunity cost of transferring goods internally when there is an intermediate external market. For the selling division, the opportunity cost of transferring goods internally to another division might include loss of contribution and profit for not being able to sell the goods externally. So it means that if I am selling to the market at 108 and 160 naira, and you are asking me that you want to buy from me at 120 naira. Now, if I were to sell to you at 120, okay, at 150, because that was the full cost, at 150, and the market is selling, if I'm to sell to the market, I'm selling 160. You see, it's 10 naira difference. Now, that loss of 10 naira, who should bear it? So it means that the selling division should be able to transfer that lost contribution. So you are telling me now that what it means is that this is buying division. They want 1,000. Market is asking for 1,005, making a total of 2,005, whereas the selling division can only make 2,000. So what happened if it makes 2,000? It means 1,000 each, 1,000 each. So who will they deny? Who will they deny the 500? Who will they deny the 500? So you see here, what happens here is give him 1,000. So you see here, this is the buying division. So this is the extra of 500. Now we are asking, the buying division has gotten 500 less than what it has. Market division has gotten 500 less than what it needs. This 2 is 1,005. Now the remainder, because these 2 will become everything, add them to become 2,000. Whom should they give this 500? Whom should they give? Now these people are buying normally at 150. This person is buying at 160. So no problem, these two are not in conflict. This 500, I will give it to the buying department at 150 that I usually used to buy, no problem. Now market, I'm giving you 1,000, just hold your 1,000 first at market price 160. Now I am now having 500 left. If I were to give this 500 to the market, I'll be making 160 each. If I were to give this 500 to buying division, I'll be making 150, but I'll be losing 10 naira. So who should I give it to? Normally, I should give it to the market, but hold on a moment. Would that make the group prosper? It's possible it's not going to make the group prosper. So if you are going to give it to the buying division will now buy it at 160. 160 in the sense that 150 the normal price and 10 naira the loss of contribution had it been it was sold to the market price. So it means it will be selling it at market price, which is the opportunity cost. So it means that 500 of it to 150, 500 of it to 160. That is what should be done. So now we have identified opportunity cost. Now this is where there is no spare capacity. When there is no spare capacity is what I'm doing here. So identifying the ideal transfer price. In identifying the ideal transfer price, there are three scenarios where we need to play out. When there is no spare capacity, this simply means that the selling division is operating at full capacity and cannot increase output beyond what is produced. So the selling division cannot produce more than 2,000. That is the capacity it can produce. And market is asking for 1,500, buying is asking for 1,000. They're asking total 2,005. It cannot produce. So the optimal transfer price here is marginal cost plus opportunity cost of making the transfer, which is what I just created here now. So when there is no spare capacity, you cannot produce more than, you need to sell that portion that is in contest at marginal cost plus the opportunity cost. All right. When there is a spare capacity, when the selling division is not operating at full capacity, the transfer price is at marginal cost. So it means that if the buying division is having 2,000, needing 1,000, and selling division has 2,000, and it is not operating at the high capacity, it will be able to sell this one at the normal 150 that it is selling to, because it is not selling at, this is not the full capacity. It can delay that of the market and still be producing more to satisfy the market, but it will give everything that the buying division asks for the price which is there. Now, when there is the limited capacity, the selling division needs to beef up additional products from external suppliers to meet the limited requirement. So it means that division B cannot produce more than 2,000. It will now go to the market and go and get additional 500. Okay, the optimal price is still going to be at the marginal cost. But most times your question is coming when there is no spare capacity. Now, the following rules should help one to identify the ideal transfer price in situation. Now, number one, begin by identifying the arrangement for transferring goods internally that will maximize the profit as a whole. So the thing is, you will determine what is the best solution for the company. So the best solution for the company could be transfer internally, or it could be please go and source it out externally. Arrange the, make sure that you first of all know what is the thing that will make the company, you know, prosper. Most times it will be given to you in the question, the policy. So they will tell you it is the policy of the company that you must buy your raw material or the component internally. That means that the company has identified that that will be the best for the company. So the first step is to know what the policy is, or to what arrangement will make the company and will be the best for the company. Now, having identified the plan that is in the best interest of the company, identify the transfer price or range of transfer prices. So it means that there will be range of transfer price. So it means that the transfer price may not be one price. So this is the floor, this is the ceiling. So it means there will be a series of transfer price. So what will be the least transfer price and what will be the highest transfer price? The transfer price must ensure that given this transfer price, the profit of the division will be maximized by doing what is in the best interest of the company. In the same way, having identified the plan that is in the best interest of the company, identify the transfer price or the price range that will make the manager of the selling division want to work towards the price, the plan, and that will also make the buying division to also do what is in the best interest of the company. So it means that the ideal transfer price, the least transfer price, is the price that will make the selling division makes zero profits, and the highest transfer price is the price that will make the buying division makes zero profits, as long as none of them is making a loss. So the transfer price is between these two prices. I'll take it again. The lowest transfer price will be the price that will make the selling division make no profit, that is break even. And what price is that? It's going to be at full cost. Now, the ceiling will be the maximum price that the buying division can buy. That is a price that will make it to also break even. And it will not make a profit or loss. That is the highest price it can go. If you sell him above that price, he will not buy from you. If you are pricing lower than the floor, the selling division will not sell for you. So anything in between will make each of the manager to make profits. That is what we are saying here. Let's illustrate it with a question here. Now, finding the ideal transfer price, no external intermediate market. When there is no intermediate market, the ideal transfer price is either at cost or cost plus a contribution margin for the selling division. We saw it there in the question. If it is transferred at cost, that if that cost happens to be variable cost, you find out that the company will be making a loss on the fixed cost. But sometimes it happens. Now, if it is on a cost plus, the selling division will make a profit. Transfer at cost do not provide any profit for the selling division. Therefore, transfer prices at cost are inappropriate for a divisional structure where it is a profit center or an investment center. Transfer at cost are appropriate if the selling division is treated as a cost center, right? So that's it. Let's look at this example. A company has two divisions, A and B. A makes a component, so A is the selling division. A is the selling division, B is the buying division. And A makes component X and transfer it to B. B uses the component to make end product Y. Both divisions are profit center. So it means that each of them should be able to make profits. Details of the selling prices are as follows. Now, division A is the one making the component, and let's call the component bottle. The variable cost of making the bottle is 100 naira, right? The fixed cost per unit, I think all these are per unit, right? All right, so the fixed cost per unit is 80. That means the total cost is 180. Fine. The selling division or the buying division, which is B, is further processing cost. We are not giving. The variable cost here is 40 and the fixed cost is 100 and 70. When we add it together, we are having 110. Now, the selling price per unit of that final product that B is selling is 400 naira. Now, they said the further processing cost of division B does not include the cost of buying the component of X from A. So this further processing cost does not include the transfer price. Now, 1 unit of X goes into production of 1 unit of Y. It's just like saying one bottle of one plastic bottle is used to make one drink. Now they said both fixed costs in both division will be the same regardless of the volume of production and sales. So it means regardless of the volume, the fixed cost is going to be the same. Now, what is the ideal transfer price or range of prices that will be ideal for the transfer price? Let's see how it is being done. Step number 1. What is the best interest of the company as a whole? Now, the best interest, if you look at it now, total variable cost of 1 unit of the end product is 140. Look at the end product is 140. Look at variable cost to make the component. You now transfer it. Variable cost of making the final product is 40. So we are adding these two together. So this plus this gives us 140. So that's the 140 they are telling us here. The is 140, so 100 plus 140. And the selling price is 400. So variable cost and selling price, what will be the contribution? So the contribution is simply 400 minus 140. That will give you 260. So for every unit of the product sold, the company is making 260 naira contribution. It is therefore in the best interest of the company to maximize and sell the production of Y. So it means they should sell Y. And how should they buy X that is being used in making Y? What will motivate the buying division to buy X from Y? What will make um, the selling division to sell to X? Now, B will want to buy more units of X, provided that the division earns additional contribution. So if you look at it now, 400 naira is the selling price. Now, further processing cost is B, is 40. If you look at it now, 400 minus 40 is 360, right? So if X is, if B is going to pay 40 naira to process everything in order to make this drink that people drinks, it's spending 40 naira to process it. If you look at just the selling price and the further processing cost, if you minus it, it means this is a 360 naira contribution is going to make. Now take note, we have not added the transfer price. If we add the transfer price, because we said here the further processing cost does not include the cost of buying the components. It was not stated what is the further processing price. Okay, further processing cost happens to be variable cost and fixed cost. Okay, variable cost 40 naira. So this 40 naira without the transfer price is still making a cost, a profit of or contribution of 360. Now it means that the transfer price that should come to B should never be more than 360. If you are telling him that you are selling it for 400, I won't make profit. If you make that you are selling it for 370, I will still make a loss. If you sell it for me at 360, that is the highest I can go. It means I will make neither loss or profit. So the highest price is this 360. This is the highest of the transfer price that will make the buying division not to make a profit. And I told you your highest price, which is the floor, is what will make the buying division to make zero profit. So if it buys it at 360, which is transfer price, if it adds this variable cost, it will become 400. And if it sells it, it's going to be 400. There will be no profit. So this is the highest it can go. It will try to negotiate it down. Now the buying division will be willing to pay up to 360 naira and nothing more. Any price below 360 but above 40 naira will increase the contribution and profit. In fact, any amount lower than 360 will increase B's profit. If it is at 360 that the transfer price is coming, there will be no profit. If it is at 350, profit of 10 naira. 300, profit at how much? 60 naira. Now, what about step 3, the selling division? Which price will motivate the selling division to make more sales? The selling division will want to make and sell more units of the components, provided it earns additional contribution for every unit of the component that it sells. Now, the marginal cost of making the unit is 100. Now we're talking about marginal cost. I made a mistake when I said full cost. It's going to be marginal cost because this is contribution. So it's going to be marginal cost or variable cost. That is going to be the minimum cost you're going to sell. So if you look at it now, what is the variable cost of A? The variable cost is 100. So if it sells at 100, it means selling price 100, variable cost 100, contribution 0. So it means that the least price that A is going to sell is 100. So you cannot be pricing me less than 100. So that's what he's saying here. Now, division A, the marginal cost of making a component is 100. Therefore, division A should be willing to transfer as many units of the component X that it can make if the transfer price is at least 100 naira. So it means here that if I'm trying to do my range of prices, it means here at 100 naira, selling division makes a profit of 0, contribution of 0, not profit, contribution of 0. At 360 naira, the buying division makes a contribution of 0. So your ideal transfer price would be between 100 to 360. So it will not be less than 100, it will not be more than 360. That is what should be negotiated. So the buying division, we want to negotiate something less than 360. The selling division, we want to negotiate something more than 100. This is just like what Labour and the federal government was doing. These people is saying you want to pay salary 400,000. The other one is saying we'll pay 60,000. They look at it. This is the least we can go. This is the highest we can go. They now have to find a middle point. So now the middle point now could be, in this case, there is no market price. There is no market price. So it can be sold between any of these. So if it decides to sell at full cost, in that case, it's going to be selling it at 180. If it sells at 180, that is full cost. It is more than the variable cost. And you see now that the selling division will make extra contribution. But this time around, it is going to cover its fixed cost. You know, at this point now that is selling at 100 naira, the selling division will be making a loss, right? But it will be making contribution. Or it will not make any contribution. The contribution is 0, but it is making a loss of fixed cost. If it decides to sell at full cost, which is 180, it means that it is going to make 0 profit, but B is happy that it is still making contribution and it's going to still make profit if need be. But they can be negotiating. If it goes more than 180, let's say 200, find out that S will make 20 naira profit. Meanwhile, its contribution will be 100 naira, but its profit will be 20 naira. Now we look at the second one, they are still making contribution in this 200. If you look at the fixed cost is 70. So they are still making profit. So you see, it's going to be a give and take. So the ideal price is between these two of them. Anything in between will satisfy them. Now, when an external market exists and there is no production limitation, when there is an external intermediate market and there is no production limitation, the ideal transfer price will usually be the market price. And the market price will normally sit in between these two prices. So you see here that the variable cost here is 600, the fixed cost is 300, total cost is 900. Division Q uses it to make his own, and sells for 2,000 naira after incurring a further processing cost of 250. The ideal transfer price is what we are looking for. If the price of the component in the external market price is 1,004. Now let's look at it now. It is in the best interest of the company that the company will benefit by maximizing the total contribution from the external sales of component X and the external sales of the product Y. If component X is not transferred by the selling division to the buying division, the buying division will have to go and buy it outside in the market. And so they will spend money on the market. For every unit of the component transferred internally, it reduces the opportunity to go to the market to buy. So it means that the additional contribution from the company for making and selling one unit of the product is, look at the price you are selling it, 2,000 minus your variable cost. Then what is the market price? It's 250. So it will give you 1,115. That is the additional contribution that you are making. Then for the other division, you are selling it at 1,004, then you are producing it at 600, you are making additional contribution of 800 naira. So the profit maximizing plan is to maximize the transfer from X, from the selling department to the buying department, rather than going to go and sell it outside. This is because this extra contribution is higher than this other one. So it will make sense for them to buy it internally. What will motivate the buying division to buy from X, the selling division? So the buying division will be prepared to buy the component as long as it is not more expensive than the market. So it means that the moment it is higher than the market price, also I will go and buy it from the market. But if it is lower than the market, I will buy from you, even if it is the same as the market. Why buy from market if I can buy from you? So you cannot sell more than the market price. So what will motivate the buying department to buy from the selling department is, if you're not selling more than the market price, I'll be happy to buy from you. If the external market price are both, if the external market price and the transfer price are 1,400 naira, then division Q would make an incremental contribution of 350 for each unit. So the transfer price is the external market price. So this is what I'm going to tell you. When there is a market price, check your transfer price. It shouldn't be more than the market price when there is no production limitation. Now, what could make the selling division to sell to the buying division? The selling division should be prepared to transfer many units of the component as long as the buying department will not be pricing it less than the market price. So that's just it. So all the examples here are buttressing these points. Okay, so what we are going to do from our next class, we are going to be looking at questions. We are going to be also looking at not just questions, we are going to be looking at exam type questions. And we said before that what are the tax implication of transfer pricing. Now, transfer prices occurs when multinational companies, these are companies that have branches or subsidiaries or presence in different countries, when these multinationals are doing business now, because they are in different countries, they have different tax system, tax rates applies differently. And so the multinationals will want to use transfer pricing to either enrich the head office that is in a favorable tax situation and suffer another country that is in a less tax favorable situation. So there is something called safe havens in taxation, whereby a country is in a favorable country, let's say Island of Man or Solomon Island, and you are in a less favorable situation in Nigeria. And now you now sell goods to Nigeria, or you sell management services, and you are charging so high, or let's say you are borrowing loan, maybe it's capital that you are giving to the company and you are giving them external capital, and you are charging very high interest, and that interest is transferred at a high cost. Now the problem now is transferring of that interest will reduce the profit in Nigeria, and it will reduce the tax in Nigeria. And now when you are transferring it to the other company, to the other group in other land, because it is coming from capital injected, it's in interest, it's possible that they will not tax it very high. It will even be, exempt from tax. So it's not even paying any tax on that revenue. But now Nigeria's profit has reduced significantly, and that is a problem in transfer pricing. Now, because this is not a tax class, I will not be talking too much about taxes. So, if you want to get to learn more about transfer pricing as it relates to taxation, please look out for my taxation video on this same topic, transfer pricing. All right. So, and transfer pricing brings double taxation arrangement because they are in different countries. It is possible that you may be taxed twice on that same profit. And so when there is a double taxation agreement, it means that one country is going to concede. If I'm taxing you in the other country, the amount you pay as tax will be deducted from Nigeria so that you will not pay double tax. That is what double taxation agreement is. If you want to learn more about double taxation agreement, go to my video on taxation, double taxation agreement. The same thing with withholding taxes. When a company is paying interest or dividend to a foreign investor, withholding tax is being charged. And sometimes these are taken as a final tax in this instance. We will not be talking much about that. We'll be solving question on this as it relates to taxation. That will be next class. So far, so good. We've talked about the theory in transfer price. We've seen transfer price at variable cost, which is the minimum cost of transfer that a selling division can make because it will make zero contribution. We also saw at full cost, which is now the minimum cost for a selling division in order not to make profit. That's the difference. Variable cost, no contribution, but there is a loss. Total cost, there is a contribution, but no profit. Now, cost plus, there is now both contribution and profit from the selling division. Then we now said that the profit should not be high as to make the buying division to run away. So the buying division is also looking at its cost so that it will not exceed its contribution. And now we said there is going to be a market price which should be considered whenever there is a conflict. Then we talk about opportunity cost. Opportunity cost is always given when there is a loss of contribution, and normally the opportunity cost will apply to the buying division when you are going to be losing contribution that would have come to you if you have sold to the market. Next class, we are going to see how questions pans out in this topic. So thank you so much for giving me this opportunity despite the challenges we had to do this class. In the next class, we are going to enjoy this topic and you will get the best of me. So thank you once again and see you in the next class.